webinar. I'm the new market analyst here at HFM. And today we're going to be looking at when to consider exiting your trade. Now, the reason why we're looking at this specific webinar today is because we've had a lot of questions. We've spoken to a lot of individuals, and they have continuously said to us, we do a lot of webinars, we see a lot of educational material in general online and on YouTube, where we're speaking about how to enter the market. And there's a lot of strategies out there on how to enter the market, but there's very little information on how specifically to be able to determine when you should be exiting the market. Because in order for us to be successful, a successful trader, we need to be able to predetermine when to enter and when to exit the market. It's not enough to have simply a strategy where you are able to determine now is the point in time where I need to enter. We need to be able to take advantage as much of the price movement as possible, and being able to exit at the ideal time in order to be a successful trader. This is something that we need to learn to be able to do consecutively. So today's a great webinar, especially for beginner traders. Everything's going to be set out in a very simple way to understand. Even if you have never traded before, or if you've only been trading 1 to 2 weeks, this is a great webinar. And we're going to be looking at different strategies and techniques which you can use to be able to determine that now is the point in time that I need to exit the market. We're going to be looking at, for example, scaling in, scaling out, part scaling, and the mathematics behind your trading plan, which is, in my opinion, probably the most important slide that we're going to be looking at as part of today's webinar. So this is what we're going to be looking at today. The first thing I want to speak about is, of course, here at HFM, we are dealing with investments. And when, of course, we are dealing with investments, it's very important that we understand that it's a specific level of risk which is involved when we are investing and when we are trading. So it's important that everybody understands this, everybody is comfortable with it before proceeding to a full investment. And of course, this is why as well we have educational webinars, because yes, we do not give financial advice, we don't give investment advice, but we want to give as much educational material as possible in order for you to be able to take advantage of opportunities within the market and to be able, ladies and gentlemen, to trade with confidence, with knowledge, and of course with expertise. So this is what we are aiming for in our webinar series in general. Today, of course, we're looking at strategies and techniques and how we can determine when we need to exit the market. But of course, each webinar is based on something different. Now, because I'm very new here at HFM, as part of the market analysis team, I wanted to give individuals a little bit of information about my background. Some of you, though, may already know me because I've been in the market now for almost 10 years. Originally started off as a financial advisor. That was in London, which I did for 4 years. Been a market analyst for a further 5 years after that. Been trading for almost 10 years. It's going to be 10 years within a couple of months. So as you can see, I've been experienced both as a financial advisor, as a market analyst, as a trader for almost 10 years now. So what we're looking to do is to be able to pass on that knowledge to individuals who are just now entering, or maybe they haven't even entered, they're thinking about entering the financial trading market. So this is what we're going to look at as part of today's webinar, which hopefully will last about 35 minutes, because of course I understand everybody is working, everybody has limited amount of time, so we want to give as much information as possible in a short period of time, of course. Now, the first thing I want to speak about, and the reason why we're speaking about this is specifically because there's a lot of educational information about this on YouTube and Google, and the information is actually wrong. It's something which retail educators think is appropriate, but in the real market is, for example, we're looking at large institutions and trading floors, which people like myself have a lot of experience in. It's something which is never actually used by professional traders. And individuals out there, they say, what is an official trend? And yes, it is important that when we're looking at an official trend, there's two types of price movements. We have what is known as the impulse wave, which is the price movement in favor of the trend. Then we have the retracement, then we have the impulse wave, and then we have the retracement, and so on and so forth. Now, this may last for 3 swings, it can last for 4 swings, it can last for 5, it can last for even longer. The main thing, of course, is that the impulse wave has to be larger than the retracement. If the impulse wave is larger than the retracement, then we have what is known as higher highs and higher lows. So you can see these areas of the market here, ladies and gentlemen. These are what is known as a high. So we are on each occasion consecutively actually achieving higher highs. And then we have the lows, ladies and gentlemen. Here we have the lows. By the way, this is just an example, so diagram. What we are going to do later on is actually look at real examples from this week's MT5. But here as well, you can see we have the lows, the swing lows, and you can see both the highs and the lows are consecutively higher on each occasion. Now, educators, a lot of the time, they say, if you're seeing a scenario like this, it means there's an upward trend, so you should go straight away and open a trade and speculate that the price is going to be moving upwards. Well, it's not always the case. It's not, if we're in an upward trend, we're always going to be within an upward trend. Doesn't mean today, because we're in an upward trend, tomorrow we're going to be in an upward trend, and we're going to for the next month. This isn't the way the market works. There's a lot of volatility within the market. So we need to be able to determine that we're going to enter in at this price at this moment, and also exit at this moment as well. So what we need to be able to do is to take advantage of these impulse waves like this, and avoid these volatile areas of the market where it's trading against the trend. This is for individuals who are looking to trade in the direction of the trend, of course. So this is point number one. It's useless to be able to say that because there's higher highs and there's higher lows, it's an upward trend, so we should trade and speculate the upward trend. Because at some point, that upward trend is going to end. And we don't want to be trading at the point of either a retracement, a correction, or the end of the trend altogether. So this is the first thing, which is wrongly taught within the market. Now, the second thing, ladies and gentlemen, is individuals will say to you that this is the breakout point. This is the point where we're going to a higher high. So as soon as we get a breakout point, so as soon as this green line here crosses this black line, and the way we identify this area, ladies and gentlemen, is we use the previous high here. So for example, we can draw another breakout point here. So if it crosses this area here, then it's an indication that the price is going to increase higher. Now, what is the issue here, though, ladies and gentlemen? Yes, okay, there's a trigger point. We use the previous high. If it's going to cross over onto a higher high, then speculate that the price is going to increase further. This is what a lot of the time what is taught. But the issue here, ladies and gentlemen, is if you're going to wait for the breakout points here, if you're going to wait until this black line, and a lot of people say you have to pass the black line, because at the black line, it is actually a point where it could be a resistance, and the price at this point may actually decline and form what is known as a double top. So people will say it has to cross this black line. So probably somewhere up here, ladies and gentlemen. The issue here, ladies and gentlemen, that nobody's ever going to speak about is that you've missed all of this price movement here in order to be able to get a signal. And if you're going to wait to slightly above the black line as well, then you're also actually trading very, very close. Let's say there's a retracement here. Then you're actually trading very, very close to where there's about to be a price movement against you. So, and most likely at that point in time, there's a loss of momentum as well. And we're going to look at real examples of this from this week. So there's two issues here, ladies and gentlemen. The issue here, ladies and gentlemen, is that if you're going to trade on the breakout, then number one, you've missed most of the price movement. Why should we try and trade in this area of the market and not try and trade in this area of the market here? So this is the first thing. The second thing is that once you've had the breakout and you're on a higher high, the sentiment and psychology of traders changes. So at that point in time, and by the way, I can see a couple of questions. I will be, of course, answering questions. I will answer questions every 2 slides or so I'm not taking up too much of everybody's time. If you're waiting to that point, we potentially may be losing momentum and we're trading very, very close to the next retracement. And that could be a retracement, which is not a big price movement, may not be an issue, but it could also be a correction, which is an issue, or the end of the trend, which is again another issue. So these are the two issues here, ladies and gentlemen. So what we need to do is to be able to determine an earlier entry point, for example, trading in this area of the market and trading in this area of the market here, because that gives us more area and more span, a larger price range for us to be able to open a trade, to benefit and be earning a profit, and to exit at a better exit point. So I've got a couple of questions here. Let me quickly answer these questions. So I've got a question here, ladies and gentlemen. Well, there's two questions. An individual has said your camera is not on. Keep in mind we're live streaming from multiple platforms. Because of that, not all of the platforms I'm able to share my webcam. Later on today, you will be able to see the webinar recording on our YouTube channel. If you go to our YouTube channel, you can see the webcam. So I apologize today, there is no webcam for example, GoToWebinar. But later this evening, you'll be able to see the webcam as well. Now, the second question is, how do I take advantage of the whole price movement? Now, this is, again, something else, this is a great question, ladies and gentlemen, as well. So the first thing that we've established as part of this slide is if you're trading at the breakout point, here, ladies and gentlemen, if you're trading at this point in the market, then the issue is you've missed most of this price movement here. And the second issue is you're very close to the point where the market is going to start losing momentum and going to have a retracement. Now, if you're trying to trade and take advantage of the whole price movement, then, ladies and gentlemen, you're trading a very risky strategy. Why? Because if you're going to trade and open a trade here, the issue, ladies and gentlemen, is that you're most likely going to have to be trading when the price is moving against the trend. So you're trading and speculating while the price is moving against you, which is very risky. So it's a lot more advantageous to wait for some price movement and some indications and then trade, for example, at this point here. And again, we're going to look at actual strategies here in the coming slide. And the other issue is if you want to trade and take advantage all the way up to the high, this is another issue as well, because it's very risky. Because if you're slightly late, then straight away you're going to get a retracement and it's going to eat most of the profit that you've actually earned over the past few minutes, the past few hours. And again, that depends on your methodology, how long you're going to be within the markets overall. So the answer to the question, ladies and gentlemen, if you want to be trading responsibly, there's advantages to waiting for some price movements in favor of the trend. We've already established that is a trend. Like we said before, there's higher highs, there's higher lows. The impulse waves are higher than the retracement. So we already know if we're getting some price movement upwards, then most likely we are going to get potentially another impulse wave. And then to be exiting the market earlier on. So we're not running the risk of exiting too late, in which case we're going to miss most of the price movement. So I've got another question here, ladies and gentlemen. Let's quickly answer this question. So the answer to this question is actually on a later slide. So please bear with me, and I will be able to answer that question in a moment because we've actually got a full slide which is looking at that. So what different things can we speak about? Here we're looking at specifically when to be exiting the market. This is actually the chart of gold. Gold is actually our most traded asset on our platform. So if we look at all the instruments which individuals can trade, and there's a lot of instruments, gold is the most traded. Now, this is something which is very important. What traders do, especially professional traders, is they're measuring the price movement, and they're continuously measuring the price movement. Doesn't mean that I'm going to measure the price movement from this week and then I'm not going to measure it again. They're continuously, week after week, day after day, they continue measuring the price movement. And now there's a specific reason why they do this, because what they're able to do is they're able to understand the characteristic of the asset, the characteristic of the price action. So they have a good idea that if there's going to be another impulse wave, then it's going to be between this range. It's either going to be 1% or the highest is going to be 1.5%. And on average, it's going to be 1.25%. If there's a retracement, if we start losing momentum and it's moving downwards, before the retracement has even ended, they know by measuring previous retracements that they either it's going to be a large retracement and they're basing it on the largest they've seen, and it's going to hit this level. It could be a weak retracement, in which case it's going to hit a high level, and they've also got an average as well. So this is an example that we've actually taken from the past 2 weeks. I wanted to give you a real example. And ladies and gentlemen, this is, for example, another upward trend example as well, because you can see we have a low here, we have a low, we have another low here, and then we've also got a high, and a high. So this is a good example of an upward trend, like I was mentioning before. But like I mentioned on the previous slide, if you're going to use this area here as the breakout point, you're trading actually in this area. Now, if you wanted to cross above the breakout point, you're actually going to be trading, for example, in this area here. So you can see you've missed all of this price movement that you could have been speculating and profiting from. And number two, you're very, very late on in the trend. And if you're late entering or you're keeping hold of the trade for too long, because this is only a 50-minute time frame, the issue here, ladies and gentlemen, is, you're going to be trading having a trade open and the market swings against you and just eats up all of that profit that you have earned. Now, if the trend continues after that and you haven't closed the trade, it's not a big issue. But nonetheless, if you see price movement against you and you're an inexperienced trader, a lot of the time you're gonna struggle to hold on to the trade, because you're gonna feel the fear factor. The market's moving against me. It's eating up all of my profit that I've earned. I'll close the trade. It's something we want to avoid. Like I said, to wait for enough momentum in order for there to be an indication that there is going to be another impulse wave. So instead of trading, for example, here, to trade here. Instead of trading, for example, at the breakout here, to actually trade here, or to trade, for example, here. It's a lot more advantageous, because then you've got all of this price movement here, which you can think about exiting the market. Whereas if you're trading here, ladies and gentlemen, there's not much price movement that you can be used that for you to consider exiting. You enter, and before you know it, there's a retracement, and you don't want to be entering, and the next thing you know is the market starts to move against you. I've got a question here: how to calculate on the market. So this is the MT5, ladies and gentlemen, the MetaTrader 5. It's free. We provide it for you for free. You can go to our website or just go to Google, type in HFM MT5, and the download button is there. On the top left of the MT5, you will see there's a cross option. Now, on the cross option, if you click that, you can click, let's say, on one area of the market, and you drag it to the next area, and it will show you the percentage. At the end of the webinar, I'll actually show you a real example of this. So what am I doing here, ladies and gentlemen? I've measured each wave in favor of the trend, and I've measured each wave against the trend. So I've got a good idea of the price action of the assets. And before the next movement even happens, I know, before it's even happening, what type of price movement potentially we're going to see. So for example, here, ladies and gentlemen, we have a retracement. The size of this retracement is 0.60. Here, ladies and gentlemen, we have an impulse wave. It's not a retracement, even though it's a downward price movement. It's not a retracement, it's an impulse wave, because we're seeing up to here, we're seeing a downward trend. And I've used this slide because it's not just one trend. We're actually seeing two trends. So if we measure this downward price movement, it's 1%. Then the trend changes. So this is the impulse wave, and it's 1.47. The next impulse wave is here, and it's 1.18. This is a retracement. It's just over 0.5%. This is another retracement, and it's just over 0.5%. Now, just by looking at this, we already can see the characteristic of the price movement of gold. Because we can see here, each time there's an impulse wave, it's approximately between 1% and 1.5%. So I've actually put this out here for you, both the impulse waves and the retracements. So the largest impulse wave we saw was almost 1.5%. The smallest we saw was 1%. So on average, if we look at the three impulse waves that we saw, on average, it's 1.21. So I know if there's going to be another impulse wave, the lowest potentially is going to be 1%. And on average, it's going to be this amount. The figures don't lie, ladies and gentlemen. When you look at mathematics, mathematics is mathematics. It doesn't lie. Doesn't mean each trade is going to, each impulse wave is going to be the same. This is the next thing that we're going to mention. And then you've got retracements. Look at the retracements. The retracements are all very, very similar. 0.60, 0.51, 0.52, 56. They're more or less the same. So we've got a good understanding. Okay, yes, there's an impulse wave. If it starts losing momentum at 0.56, which is the average, it's going to potentially lose momentum. So again, how are we going to be using this, ladies and gentlemen? If we see an impulse wave like this, and we're moving like this, and so far we've moved 0.10%, for example, I know before the movement has even happened that if we're looking at the average, the price is going to move all the way up to here, which is 1%. So I already know this is the target. Now, the next thing, at this point here, a retracement. Before the retracement has already happened, I know on average we're looking at 0.56. So it's going to decline all the way down to here, which is 0.56. So I know even before the market movement happens, there's a possibility that the price is going to do this, and then the price is going to do this. Now, some people are going to say to me, not all impulse waves are the same. And this is the reason why, ladies and gentlemen, we have the largest impulse wave, the smallest impulse wave, and also we have the average. Now, the next thing I will say is professional traders, they don't try and aim and earn the whole of the price movement. Like we said, if the price movement on average is saying it's going to reach this level here, they may say, I'm going to look at 25% lower. So for example, I may trade here, but I'm going to exit here because I don't want to risk holding on to the trade too close to the end. So they're looking at the average, but they're actually saying, I'm going to exit 25% lower, for example. So if the whole price movement is 1%, at 0.75%, I'll exit the market. I've got some questions here. How can I join this? Also, ladies and gentlemen, if anybody else wants to join and re-see again live webinars, you can have one-on-one sessions. You can speak to our support team. You can speak to our account managers. Very simply, go to Google, type in HFM or HF Markets, and as a register, you can register for free. You get all of the educational material for free, of course. So hopefully that answers your question. How do I calculate the pips on the market? There's again, it's the same individual that asked me how to calculate before. You can use the cross tool. If you click the cross tool and you drag it, it will show you how many pips and pipettes there are in the market. I'll show you this at the very end of the session as well. So hopefully that's educational. This specific slide is very important. Every single day, every single week, measure the price movement. Have a little table like this so you can see the characteristic of the asset, because of course the characteristics of gold is going to be different to the characteristics of let's say the Nasdaq or the Dow Jones. So this is very, very important. It's very beneficial, of course, for traders as well. I've got some other questions as well. So I've got somebody here who's saying he cannot hear. If you cannot hear, you can go to YouTube and watch the webinar live there. Got another individual who says, is the webinar presentation available? Yes, it is available. We'll also send you the recording of the webinar. I've got another individuals. Help me again how to determine the percentages. At the end of the webinar, we'll go to the MT5 together and I'll show you this actually live on the MT4. So this, ladies and gentlemen, is very, very important. It's not the most important thing I would say as part of this these slides that we're going to be looking at today, but it is something very important and it's something very simple for you to do because the cross tool on the MT5 will do this for you. So it's something very, very important. Now, the next thing is trading plans. There's a lot of information, a lot of videos on YouTube about trading plans. Turn it into a business plan. There's a very big difference between a business plan and a trading plan. Now, this is just an introduction of the next slide. The next slide is the most important slide of this webinar. So a trading plan, yes, it will tell you the risk, it will tell you the exposure, it will tell you your take profit, your stop loss, it will tell you what assets you're going to be trading, which times you're going to be trading, and so on and so forth. But turn it into a business plan. Now, what do I mean by a business plan? What is the difference between a trading plan and a business plan? A business plan, ladies and gentlemen, you're looking at turnover and you're looking at expenditure. Everybody will have a trade which is losing and they have to close it. This is an expense. It's not an issue. Every business has expenses and every business has revenue. As long as your revenue covers and is above your expenses, you're a profitable business. And the same thing applies to traders. A lot of traders that I speak to do not close their trades which are in a loss. Or what they do is they open many trades. They try and earn 0.10% on their trade. So they're closing a lot of trades, 0.10%, 0.10%. And then if the market moves against you, they're allowing the market to move against them by 2%. So they've lost everything they've earned on the previous 20 trades. This is why there's limitations to a trading plan and there's benefits to a business plan. A losing trade is not an issue. Don't worry about closing losing trades. It's an expense. It's fine. As long as it's a controlled expense, and we're going to look on the next slide about how to control these expenses. And as long as your revenue, your winning trades are far more than your losing trades. So this is the first thing. This is just a very quick introduction. The next thing is 90% of traders which are unsuccessful. They're unsuccessful because they don't close the trades which move against them. They leave them open and they see such a large loss because they refuse to close the trade when the market is forming a trend against them, where it's a large loss and they become uncomfortable closing the trade. The trick is to close the trade earlier so you're not in that situation where you're uncomfortable to close the trade. Now, something which I'm going to say, people may not 100% believe, but I'm going to justify it now. So, statistics behind your trade. What I will say is every single trader can be a successful trader, whether they're able to determine how the market is likely to move or not. And I'm going to give you some real examples here. Whether you are amazing at analyzing, like myself, and you're able to determine how the market is likely to move, you can be a successful trader. But if you've never traded before, you're inexperienced, and you are unable to determine how the market is going to move, you can still be a successful trader if you're using the right mathematics behind trading. And I'm going to give you an example here of how an individual who is terrible at determining how the market is going to move can still be profitable if he's using the right mathematics. So there's three things we're going to be looking at here. Number one, you need to be looking at how many trades you open every single week. Now, try and open the same trade sizes because management and these calculations become super simple if you're opening the same amount of trades every week and the same trade size. So, for example, we're going to be using 30 trades per week, and it could be, let's say, one lot, but it's just for an example's sake. The next thing that we need to look at is the reward to risk ratio. The reward to risk ratio, so it's also known as R, the reward to risk ratio. So it means how much am I looking to earn per trade compared to how much I'm willing to risk per trade. And you have to be very strict on this. Now, why am I saying the mathematics behind trading? Because you can use your reward to risk ratio and your success rate plus the amount of trades that you open every week to ensure that you are profitable. Now, this is because you're using mathematics. So, for example, we have stated reward to risk ratio, your success rate. What is a success rate? If you're opening 10 trades and from those 10 trades, 7 trades you close in a profit and 3 trades you close in a loss, you have a 70% success rate. Very, very simple. And the next thing is how many trades you open per week. Now let's look at our examples and you'll know exactly what I'm referring to. So the first individual, the first trader is John. John opens 30 trades per week. He has the standard reward to risk ratio. This is the reward to risk ratio everybody will find on Google and on YouTube of 2 to 1. So per trade, he is going to be, per $1 he's risking per trade, he will look to earn $2, which makes sense. Okay. So basically, he's looking to earn $40 per trade and he will risk $20 per trade. And he has a success rate, a decent success rate, not high, not necessarily low, of 67%. So based on 67% and 30 trades, it means that he closes 20 of the 30 in a profit and 10 in a loss. So that means, ladies and gentlemen, if we're doing 40 times 20 trades, that he's earning 800 turnover. So his profit is 800. And if we take 20 times 10 trades, his expenses, his losing trades, is $200. So at the end of the month, he's earning $600. And he's not a super successful trader, only 67% success rate. It's absolutely fine. Let's look at example number 2. This trader is called Jude. Jude has a a negative reward to risk ratio. Some people may say this is crazy. A negative reward to risk ratio. What does this mean? It means per $1 that he is looking to earn, he's risking 5 times more. He's risking 5 times as much. So per $10 he wants to earn, he will risk $50. Now, there is an advantage to this because if, let's say, we see a price movement like this and somebody's trading here, if you're putting a closer stop loss like this, just a little volatility like this knocks you out of the market. But if you open a stop loss which is further away like this, then it leaves time and space for the market to do its thing. So there's advantages to this. He has a 90% success rate. Why? Because he's allowing the market time. So he's got a very, very high success rate, and also potentially because he's able to determine how the market is going to move. So he's earning 27 trades in a profit and 3 trades in a loss. So let's say, for example, $10 is 270, 10 times 27, and then $50 times 3 is 150. So he's still a profitable trader. Let's look at Mary. So this lady is a trader. She's only got a 35% success rate. She is terrible at determining how the market is going to move. She's still only opening 30 trades, but she's not able to determine how the market is going to move. Maybe she's a beginner trader like some of the individuals watching today's webinar. So here, ladies and gentlemen, I've got a question. We'll answer this question in a moment. Here, ladies and gentlemen, she's got a 4 to 1 risk ratio. So she's looking to earn $32 per trade and she will risk $8 per trade. So she's only earning a profit on 11 trades and a loss on 19 trades. So she's earning a loss more than she's earning a profit. But because the maths behind her business plan is correct, she knows that if she's got this reward to risk ratio here, that her turnover is 363 and her expenses is 152. So here, ladies and gentlemen, she's got $152 profit. So even though she is not able to determine when the market is going to move in a certain direction and when she should be exiting, because she's looking at the mathematics behind trading, she's a very successful trader. And she's even more successful than the individual who has a 90% success rate. So here, ladies and gentlemen, is a good example. No matter how great you are trading, if the mathematics behind your trading plan is correct, you are still able to be a profitable trader. So let's quickly look at some questions because we've got some individuals who are asking questions. Let's have a look at these questions. Is there a tool on the MT5 which establishes the reward to risk ratio? No, but you can use pips. So, for example, my reward target is 10 pips. My risk target is 5 pips, which is basically a 2-to-1 reward to risk ratio. There is a calculator that works out the pip value on our website and also on the MT5. So it's very easy to work out. Also, you can speak to your account manager. They can show this to you as well, of course. Another thing that I'll say, the last thing as part of this slide, and then we'll move on to the next slide, is these calculations will only work if you're true to yourself about these about your success rate. If you are using a success rate of 70%, but your success rate is 60% in real life, the calculation is not going to work. So you have to be true and honest with yourself. So let's look at other things because the mathematics is pointing out to you when you should be exiting the market. Very, very important. Now, other things to consider in terms of how to exit the market. So here, ladies and gentlemen, we have an oscillator. An oscillator is a technical indicator which uses price movement to measure when the price is overbought and oversold. Now, what does overbought, oversold mean? It means if the market is too expensive or if it's too cheap. If it's too expensive, people most likely are going to be buying and the price is going to decline. If it's too cheap, people demand will grow and people will buy, in which case it will start to increase. We'll look at an example of this on the next slide. If the price is getting close to being too expensive or too cheap, you should be exiting the market before this point, unless there's a reason you believe the indicators are wrong. So, for example, maybe because of some news which is going to be released, whatever it may be, you believe it's going to keep on moving, but you have to be sure about this. Then, of course, you can keep hold of the trade and keep trading in the overbought area of the market. Otherwise, it's an indication that you shouldn't be still holding on to the trade. You should be exiting. The next thing is a trailing stop. Instead of using a stop loss, you can use a trailing stop. Now, what is the difference? For example, if the price movement is doing something like this, you enter a trade here and you put a stop loss here. Okay, let's say minus 10 pips, 10 pips below the current price. And let's say the trade does something like this. So we're now 30 pips in profit. Your stop loss will still be here, ladies and gentlemen. So if the market moves against you, you're going to end the trade in a loss. But a trailing stop basically follows the price as it keeps moving up. So you set a percentage below that you want to stop the trailing stop to be. So for example, you can set it at 1% below the current price. So if the price increases like it has now increased to here, your trailing stop will actually be at this level. So if the market starts to decline, it will close here. So it closes above where you entered. So it's actually not only protecting you against excessive losses, but it also protects a certain percentage of the profit that you have earned. Now, some people, point number 3, are going to say to me, but if the markets moved down to here and then it moved up to here, I've missed out on a higher profit. It's not an issue, which is why I put point number 3 here. If the market came down to here and then starts to increase again, you can open another trade. It's not an issue at all. You've safeguarded your profit. You've closed the trade in a profit, so happy days. And if it starts to move again in that direction, you can open another trade. You've not missed out on any profit whatsoever. Second thing, support and resistance points. So if there's a line, if there's an area that if the price continuously hits that area and just keeps finding resistance there, and let's say we're down here now, price increases like this, and we think it's going to increase all the way up to here. Yes, we can trade. We can open the trade here. It increases, but we should have that level in mind, and not only have it in mind, but leave some gap here to ensure that we're not trading irresponsibly, that we're not trading with so much risk. So, for example, exiting the market here. So we have to keep an eye on support and resistance points. Breakouts can be a bad idea. We've spoken about this already. Breakouts can be a bad idea. Trade below the breakout. If you've established an upward trend, establish how much momentum there needs to be in order for there to be another impulse wave. And also, this is where measuring comes into fact as well. If you've measured an impulse wave and it's 1%, and then, for example, we get a retracement, the retracement 0.20%, another impulse wave, 1% again, another retracement, 0.20%, another impulse wave, 1%. Now, if it starts to decline, and it declines to this level and is now at 0.20, and then it starts to move upwards, for example, here, then you know that it's following its standard price action characteristics, and it's going to potentially keep on increasing to 1% because the retracement has already formed. It's forming the same size retracement as it has done throughout the day, throughout the week, throughout the month, whatever it may be. So you know that you can trade and potentially speculate here. You don't have to wait for the breakout point here, in which case, again, you've missed most of the price movement and you're trading too close to where the trade is actually going to end. Fundamental exits, something for you to consider. It's not the same as exiting before news. Fundamental exits is actually if there's a significant announcement on Friday, you're thinking about exiting Thursday morning, if not Wednesday afternoon. So there's a difference there, ladies and gentlemen, because if there's news coming out, people will start to position themselves 24 hours before the news. For example, 24 hours before non-farm payroll. So the price will start changing before. So you have to keep that in mind. Then we have scaling in and scaling out. We also have part scaling. This is the last thing that we're going to look at. This helps with exiting. You can also use it to help with entering. What is scaling in and scaling out? So these orange lines here, ladies and gentlemen, is entries, and these reds are exits. So there's different ways that we can scale in. Instead of opening, for example, a trade which is 3 lots here, and your take profit, ladies and gentlemen, for example, is here. This is the take profit. Or for example, your take profit may be here, for example, the whole of the price movement, whatever it may be. It's just an example. Instead of opening one trade, which is 3 lots at one price, you're actually mitigating the risk. You're spreading the risk, ladies and gentlemen. So instead of doing that, you open one trade here for 1 lot, one trade here, another 1 lot, and one trade here, another 1 lot. So I'm splitting it up by 0.29%. Again, as an example, you may split it up by 0.20%, 0.10%. And the benefit of this is you're spreading the risk. Your entry is not so much important because you're entering at 3 different levels. Your exit, today we're looking at exits. Your exit is not as important because you're exiting at 3 different levels as well. So the first trade I've opened here and my take profit is here. The next trade I entered here and my take profit is here. The next trade I entered here and my take profit's here. Now let's say the price didn't move up to here. Let's say the price moved up to here. My first trade profited, my second trade profited, and my third trade didn't profit. So at the end of the day, I'm still profitable. I'm still profitable because the first 2 trades were profitable, the second was not profitable. Whereas if I opened 3 lots here and my take profit was here, but the price only moved up to here, all 3 trades will be in a loss. So I'm entering at different levels. I'm exiting at different levels as well. This is known as scaling in and scaling out. Now, the next thing that we can look at is path scaling. This is specifically for the exits, to help with your exit. So this is where you open 3 trades, all one lot. Instead of opening one trade for 3 lots, it's 3 trades, all one lot at this price here. But you close the first trade here, you close the second trade here, and you close the third trade here. So they're all at the same price that you're entering, but you exit at different prices. This also can help with your exits. Now, oscillators, we mentioned oscillators as well. This here is an RSI. This is an oscillator. It's got 4 zones. If we're trading between these 2 lines, it's indicating that buyers have control. If we're trading below and we're trading between these 2 lines, sellers have control. If it hits the line here, or if it hits the line here, it's overbought and oversold. If the price is above, for example, here, ladies and gentlemen, the price is too expensive. If the price is below, the price is too cheap. So this is a real example from today, ladies and gentlemen. So you can see here, the price continues to increases. Some people may be thinking, let's buy. Wait, no, we're overbought. So it's indicating the price will decline. What happened? It declined. Same scenario here, indication the price will decline. Price declined. Here we have an indication the price will increase. So the price here actually increased. So this helps us as well with both our entry and our exits, not just our exits. But if we're getting close to that overbought and oversold areas, then we really need to think about not opening any further trades, but also exiting as well. Are there any tools to put on trailing stops? What do you mean by tools? The trailing stop is a tool itself. So if you right click on the chart, you'll see there's an option there. Or if you've already opened the trade, you can right click on the trade itself. You'll see there's an option there for trailing stops. So hopefully this was also beneficial, ladies and gentlemen. So this is a strategy that we're going to be looking at next week. Helps with both exiting and entering as well. So, and it's a very, very simple strategy. I try to make a strategy as simple as possible. This is a momentum-based strategy. So there's 4 indicators here. We have a moving average here. It's a simple moving average. We have another red line here, which is a simple moving average. This red line here is a 14-bar simple moving average. This yellow line is an 8-bar exponential moving average, so an EMA. Then we have a stochastic oscillator here. So similar to an RSI like we looked at in the previous slide, slightly different now. So how we're getting indications that individuals should be potentially buying and exiting the market. Yes, it does work also on MT4. If we're referring to the strategy here. So if the price is below, then we're only looking at opportunities to speculate a decline. Doesn't mean it's below, we instantly sell. Because you can see here it was below, but it moved upwards. Here it was below, but it moved upwards. Doesn't mean we instantly sell, but it means we start to only look at opportunities to sell. And then what we want is a downward crossover. So we want the price to be below and a downward crossover as well. So here you can see the yellow crosses the red downwards, and you can see the price decreases in value. Great signal, would have been profitable if somebody traded this. This was from yesterday, ladies and gentlemen. It's not an old example. This was from yesterday. Then when do we get a next signal? We got a signal here. Again, we can see the price decline. The next signal we got, this next signal was here. Now, I wanted to take a screenshot of this before the price movement actually happened. So you can go on to the MT5 and you can see, I'm not using past examples. This is a signal. You can see the yellow crossed downwards against the red. So it's a signal the price will decline. If you go to the charts now, you can see that gold declined. In the next hour and a half after this signal, hour and a half is more than enough for individuals trading. And the price declined actually to a lower low. So it's lower than what can actually be seen here on the chart. So you can see we've got 3 trades, all trades profitable based on this strategy. So very simply, if the price is below, we only look at opportunities to sell. Then we wait for crossovers, crossover here, and a crossover here. If the price is above and we get an upward crossover, we can speculate that the price will increase upwards, of course. Now, what do we also want to do? We want to check our stochastic oscillator. Now, we want both the lines, like you can see here, like you can see here, and like you can see here, to be below the 50. If we're below the 50, then we're all clear to speculate a decline. But we don't want it to be below 10. If it's below 10, like for example here, it's too late, it's too cheap, there's a risk of a retracement, so we don't enter. The next thing is we also want the latest crossover on the stochastic oscillator, like this, to be downward, a downward crossover. We don't want an upward crossover. So ladies and gentlemen, that is the end of today's webinar. We're going to look at some of these factors in more detail, of course, on our next webinar, including that strategy. We'll look at it in more detail, more step by step. That was just a taster, but a strategy on how you are able to determine when to enter and exit the market. Now, in terms of this, let's go back to this chart very quickly. In terms of exiting, for example, again, you can use scaling in and scaling out. So we had a crossover here, that's one trade. A second crossover, that's a second trade. A third crossover, that's a third trade. So you can scale in. Instead of opening on the first signal 3 lots, open 1 lot. The next signal, a second lot. The next signal, a third lot. Doesn't mean you trade more. You're trading the same size, but you're opening smaller trade sizes. So hopefully that answers the question on how you can also use what we looked at as part of today. And then, of course, like I mentioned, you're going to be using the reward to risk ratio compared to your success rate. So mathematically, what needs to be the reward and the risk in order for you to be successful? And the next thing, of course, as well, impulse wave, measure it. Impulse wave, measure it. Impulse wave, measure it. Retracement, measure it. Retracement, measure it. Retracement, measure it. It will show you exactly when the next price movement is forming, approximately before it even forms, what kind of price movement potentially you're looking at there being in the market. And then the next thing, like I said, not at the breakout, before the breakout. For example, here, look at this. Somebody traded this breakout, they'll be very, very unsuccessful. This is the breakout point. People online will tell you, trade at this point. As soon as it crosses over here, trade. It did move a little bit in our favor, but not enough, and the market moved against us. Instead of trading there, ladies and gentlemen, you could have traded here, which is more than enough price movement in order for you to open a quick trade. So hopefully that answers your questions, ladies and gentlemen. Let's see what other questions we have as well. Bear with me. Let's have a look. So I've got some more questions. What is the time frame? On the latest chart that we looked at, it was a 4-minute time frame. So more for day traders, intraday traders, so individuals looking to earn 10 pips, 10 pips, 10 pips, could be 9 pips, 8 pips. Of course, that strategy is something you can amend on a different time frame. We're going to look at that next week. So you can, of course, amend the reward to risk ratio. Sorry, I came late. Can I have the recording? Yes, of course, everybody that registered and attended will get the recording. Can you show me how to determine the the price movement, the crossovers? Of course I can. Just bear with me a moment. Bear with me, ladies and gentlemen. Hopefully everybody can see. Yes, they can see. All right. So look at this cross tool here in the middle of the screen, ladies and gentlemen. Let's bring it a bit slightly downwards so everybody can see. There we go. Now, if I click on that and I click anywhere and drag it, you can see there it says 29. So that's 29 pips. And you can also see there 0.28%. So some people use pips, some people use percent. It gives exactly that. Let's open a new clean screen like this. Let's go on to a 15-minute time frame because see if these are more short term, let's say I want to measure between here and here, you can see 0.37%. Let's say we want to measure the retracement. This is the retracement 0.20%. Let's measure the next retracement like this, 0.32%. Again, just by looking at that, it's exactly what I was saying before. It's very, very similar. So just by doing this, you're getting a good understanding of how you can use measuring both the retracement and the impulse weight to get a good understanding of not only when to exit, but also when to enter as well. Is this only for gold? No, you can use it on any asset. The only thing is you may need to change the parameters. Maybe 14 simple moving average and an 8 exponential moving average is different. It's not appropriate for example, oil, which is more volatile. The strategy is appropriate. You may need to change the parameters of the moving averages though. Okay, so I can't see any more questions. So let's end today's webinar. Thank you everybody for joining. Trade safe, trade responsibly, and hopefully we'll see you very soon on our next webinars next week. Enjoy the rest of your weekend and